Good morning, Kristen.
Good morning. How are you?
I'm good.
Good.
Thank you for the Starbies this morning.
You're welcome.
Caffeine is necessary.
We need a Starbucks for the, big commencement of episode 2 of our podcast of the Tax Sisters.
Oh, yes, episode 2. And I think we're here to talk today about last time we were talking about entity structures and the different types. And we talked about single member LLCs, sole proprietorships. And today we want to talk to you about partnerships.
Yeah,
right?
Partnerships. We see these a lot, right? Two people going into business. They're
At least
both
two.
good. Yeah, they're both good at what they do, and they're starting to get things kicked off. So couple things we're going to hit on today about partnerships, like what is a partnership, who goes into the partnership, what kind of obligations does a partnership have for tax filing, stuff like that. And then most of what we're going to cover is the tax treatment of partnerships. So
yeah, funny thing this morning, I was having my morning coffee, tried sitting outside, but it was still a little too muggy hot, and I was scrolling Instagram and I found one of those
you sent it to me.
Grandiose claims by someone on Instagram. I just want to read it to you. It says, and it was perfect timing for what we're going to talk about today.
Yeah. Yep.
Your sole prop LLC is a rowboat. A multi-member LLC is a yacht with tax-free cabins and liability-proof lifeboats. All you need to get the yacht instead of the rowboat is do a few small things. Sounds really interesting, huh? Man, I want to be a partnership now. I want to drive the yacht.
Well, to a normal person, it's like, oh, I definitely need to be a partnership.
Yeah.
I definitely, what am I missing out? I'm going to save all this money. And that's the thing about Instagram. And that's what we're going to talk about.
Yeah, because the grandiose statements out there, and I know a lot of them are just hooks trying to reel people in.
They need to like, they need to follow.
They need to follow. They want to sell something, a book or something like that. And it's interesting. And I probably would say a yacht and a lifeboat, that's ridiculous. Because I think they serve their own purposes.
Yes, yeah.
And sometimes if you're a sole proprietorship or single member LLC, that's perfectly fine depending on what you're doing and your situation. So let's talk a little bit about what a partnership is.
Yeah. So tell me, give us from sole proprietorship last episode, give us a 90-second overview of what a partnership is.
Well, yeah, a partnership typically is when you go into either a formal or informal arrangement or agreement with a partner, hence the word partnership.
Right.
And it could mean one other person. It could be 10 other people. Partnership's just it's 2 or more people involved. And there are different types of partnerships, which makes it pretty interesting. So it's a little bit more flexible. We have your most common, which is your general partnership,
right?
Where, say you and I wanted to go and start a
ice cream shop.
Okay, she's hungry. Ice cream shop. And, we're going to go into it 50-50. She's going to do sales. I'm going to scoop the ice cream, whatever the case may be. We'll have our job responsibilities. We're 50-50. That's usually your most common setup you see, because that's what most people know. Either it's 50-50 or, there might be different percentages depending on how many people involved and all of those things. And that's typically your general partnership. Everything is split. Your capital is split. Your profits and losses are split.
Right.
Your liability is equal in the partnership, all of those things. Then we have things that are a little less heard of, one's called a limited partnership. You've heard of that one?
Yep. Definitely heard of that one.
So what's the difference? A limited partnership is usually I'm going to open the ice cream shop. I know how to get the business, the marketing done, but Kristen's a chef. So we're going to have her actually
making all the ice cream, making the recipes.
Get me the recipes and stuff. But she's really not going to contribute money or any of those types of things. So she doesn't want to be completely liable for the whole thing, but she wants to have, some type of vested interest and so forth. And I'm going to use all her recipes. So it might be that I'm the managing partner. I'm the one who's going to run everything, make all the business decisions, all the operations. And Kristen's going to have a vested interest in the partnership, whether it's from her contribution of her recipes or whatever, could be other assets, but she's going to be a limited partner. She doesn't have any operational responsibility whatsoever. Her liability in the company is limited to what she's put in, hence limited partnership. So usually there's a general partner and then one or more other limited liability type partners. And that's important because that one partner isn't taking on full liability and responsibility for the entire operation. The term implies, limited.
So when you're talking about liability, right, you want to expand on that. Can you explain to just a regular person what liability is? Is it money liability? Is if someone got sued liability? Like what kind of liability are we talking about?
All of the above. Any kind of liability someone brings to the table. You could have tax liabilities, you could have human resource liabilities, you could have state liabilities, you could have legal liabilities just for, somebody trips and falls on your ice cream that you didn't clean up off the floor.
Yeah.
And boom, down they go and you get sued. Again, by limiting that one partner has got their liability is limited. It's limited to a certain portion of their investment. So they get sued for $1 million, but their limited liability is only 10,000, they don't have as much to worry about. So it is have a good way to protect certain individuals in those types of relationships.
Yeah, that makes sense.
But the last one, and I think people know of this one a lot, but they don't really acknowledge it this way because it's called a limited liability partnership. So not limited partnership, but limited liability partnership. Why are those different? Well, in a limited liability partnership, typically all of the members are limited in liability. And I try to liken that to, if you think of like a big law firm.
Okay. Yeah.
Or a big accounting firm. And
Yeah.
Everybody's
10
always,
partners,
everybody's
12
striving to be partner. And it sounds weird. Why would they make all these people partners? But it's like they can share in the profits, they can share in all of these things, but they are limited. They don't manage, they don't run, they don't make any business decisions. And again, their liability is limited. So you see that in like big law firms, big accounting firms. You'll see that in consulting firms, architectural, a lot of professional.
Did you ever watch that show? It's with that guy who fakes that he's actually a lawyer. I was telling you about it. It's coming out with a new season. Oh, Suits. Everyone's making partner.
Suits. Yes, I love that show, actually.
That's what it just made me think of.
Yeah, he was fake partner. But when they get partner, that's exactly right. That's what we're talking about. And you see a lot in professional organizations where partnerships are something to achieve and stuff like that. So those are the three different types. I think mostly what we're going to focus on is general partnership type of situations.
Sure.
Doesn't mean there's going to be flow over and all of that. But since that's the most common, that's what we're going to focus on today. Yes, and I don't believe it's a yacht versus a rowboat. I think everything serves its own purpose.
It's just how you row the boat. All the boats are the same. It's just how you row it. You got it motored, you got this, you got that. But going off of that, and now that we have a high-level overview of what a partnership is, how do you establish a partnership? How do people get going? I mean, we know a lot of people that just go into business and they're all of a sudden like, nope, we have a business, but they haven't done anything to structurally make everything sound, like we talked about in our first episode, creating the foundation.
Yeah, the foundation in a partnership now gets a little bit more complicated. It's not so much in the forming of the entity. We follow the same process that we did using a single member LLC to a multi-member LLC, except we're going to have more members. What really contrasts what you need to think about before you just jump off the ship and go basically forming something blindly, because people have to remember is when you own stock or a piece of a business, it's personal property. You can't take it away. That person stops performing and you're like, that's it, you're out, we're taking your stock. That's not legal. People do it, but it isn't legal. So it is personal property. So you want to have, before you actually form that and start handing that out, those pieces of your business, you want to make sure that you have put some forethought into it. And the reason for that is because of liability. It is because of the what ifs. And the biggest thing I warn people on whenever they come in here and they're going to start a business with their mother, their uncle, their brother, or their best friend, or anything like that is, do you have a partnership agreement? I harp on it all the time. And I can't tell you how many times you'll be like, oh, I don't need that. Or I'll go online and print one off of LegalZoom.
Shout out LegalZoom, you're great.
Yeah. Great to an extent, right? Templates can do so much for us, but do they protect in every situation? And the answer is no. And the whole reason behind having an operating agreement or partnership agreement, however you want to reference it, is really for the times that things aren't so great.
Yeah.
Definitely want to have ideas of how things are going to run, how decisions are made. Are they unanimous? Are they 50-50? Are they, you don't agree and I'm the manager, so I'm going to get the final say? You can have lots of different ways you can settle those types of things. some of the bigger,
we see a lot with one of our bigger clients that they have to do votes, right? Who's got more votes on what side?
yes, like who's got what type of voting rights and so forth is really important. But how ultimately those disputes are resolved are really where the operating agreement steps up. People tend not to think about, they think about how to get started in a partnership. They don't think how to end a partnership. So might be great today. You and your best friend going to go start an air conditioning company. You go out there, you know, one's got all the contacts and the history. The other one's got all the skills. And you're like, this is just a marriage made in heaven. We're going to start this business. But they don't think about things that are actually really common. You know, the person doing most of the labor ultimately feels that the marketing guy isn't doing anything or isn't selling enough and isn't pulling his weight. And then, you know, bad blood begins to develop. And now one person's like, I want out.
Or selling.
And how do you get out of a partnership, or how do you actually maneuver around these disputes? And that's where I just don't let off the gas pedal when I tell people, if you're going to go into anything like this, you need a partnership agreement. You need it to be binding, and you need to think about things like anything from just your basic disputes on how to operate, who's in charge, but things like, what if one of the partners passes away or some unfortunate
or they
circumstance
can't work for an extended amount of time.
Yeah, or the disability. Again, going back to your ownership in an LLC being personal property, you know, if I pass away or someone passes away in a partnership, their heirs now can inherit that piece of your business, and now you're going to do business with the wife or the son or the daughter or whoever, the dog, whoever they left their business. You know, I've heard of crazy things like that.
I actually heard someone today on the phone that they are telling me that they are leaving all their assets and all that stuff to their caregiver.
So see, it happens. And then now you're in business, you built this business, and you're stuck working with the cleaning lady, you know, or the dog or the brother or the sister. And, you know, they don't know anything about what's going on, but you don't have a choice now. So what do you do? And these are important things to think about because they are common.
Well, it's life.
Extremely common. We've had plenty of people come through here where one of the partners passes away, or there's a disagreement, and partnership divorces can get ugly. So it, to me, is the biggest.
When they get expensive, a lot of people don't realize that when people are upset or they make harsh decisions, etc., and one person wants to sell, two other people don't, and then we're in this huge battle of, well, I want out for this, and comes a whole like scandal.
Yes, and we see our fair share of what we call partnership divorces over the years. I think we're in the middle of a few right now, and they're not fun. So we really, really push hard and encourage people that few $1,000s they invest up front to get a partnership account.
Solid attorney.
Solid with a good attorney is definitely worth the investment. So I'm spending a significant amount of time on that because it is probably the #1 downside to a partnership is people go into it a little blind and they're not prepared for how to get out or how to sell or how to do any of these things. So before going into a partnership, to me, that is one of the single most important things to have outlined and documented before you actually engage, not after, not once you've started, not in the middle of it. Can't undo those things. So
well, it's good when you start off, right? Because you got to agree on all these things. So when you just start making these decisions in the middle after, say, you've made a buku amount of money and all this stuff, emotions start getting into it. If you do it beforehand, the emotions all taken out. It's cut and dry, you've decided on it, and then you can move forward and just focus on business.
Right. And it does, and then if you end up in some type of lawsuit, it does give that structure to be like, hey, well, you agreed to this, and it makes it a little bit harder to do any kind of, fancy outpacing of all that.
Well, while we're on the topic of, figuring things out at the end of the partnership, when they dissolve or whatever, what about the responsibilities of partners while they're in the middle of partnerships? What are they obligated? Do they have any differences from a regular sole proprietorship? All that stuff.
Really all rolls back to your operational agreement and your roles, responsibilities. Who's going to be in charge of what? Is one person going to be primarily in sales and one person going to be primarily overseeing operations? What? And drawing those distinct lines becomes important. You don't step on each other's toes. Right. Everybody has objectives to face. Again, like even things like you were referring to about, profit sharing. How do you split this? And all of that goes into your operating agreement. So we're kind of rolling back into really saying that's the foundation in a partnership is really going into it knowing all of these things up front. you get past that, I think you can be pretty much smooth sailing in that.
Yeah. In the operating agreements and stuff like that, is it also set forth of how you're going to expand if you wanted to acquire other people?
Absolutely.
What happens if you run out of money? All those things?
All of those things.
Yeah.
It's really pre-planning for all of the things that could happen, need to happen. Companies struggling for make money, and now you need money to operate. Where does that come from? Usually that's something called a cash call. And depending on, if you're a limited partner or what your agreement is, that cash could be coming from equally from all of its partners.
Right.
Depending on what your pre-agreements are. No agreements, you might as well just keep it equal because that's the default of what everything is. We're going to take a quick break and then go back into some tax treatments of partnerships so that we can understand some of the differences between the sole proprietorships and the partnerships.
Second portion of our episode 2, we're going to talk about the tax treatment, how and what they file on, pass-through taxation, self-employment taxes that flow through, and common deductions, right?
Yeah.
So let's touch on, what do they report their business on?
So typically people wonder, tax treatment of a partnership, somehow they think that's some vastly different type of scenario. And it isn't actually. But the main thing to think about is opposed to like a single member LLC or a full proprietorship that will tend to file their tax return on their personal tax return.
Right.
It's literally it is a pass through.
Mm-hmm.
People will go, well, partnerships are pass through entities too. Don't I put that on my personal taxes? And
yeah.
I'm like, no, it's not done that way. So what happens is a partnership will file on what's called a 1065 partnership tax return. Partnerships are tax reporting entities. They're not tax paying entities.
Right.
So the 1065 is used to report the partnership income, expenses, depreciation, all of that stuff. And then what it does is it kicks out what's called a K1 that goes to each partnership. And I just, for people mentally relating, I usually say, hey, think of a K1 like a W-2. It's a document you're going to get at the end that then you're going to use on your tax return to report your business income or your business losses, your business basis, all of those things.
Yep.
That's what's reported on the K1. You take that K1 to whoever's doing your personal taxes, and they will incorporate that into your tax return. So the business itself is not paying taxes. Each respective partner is paying their share of the taxes.
Right.
Now, what gets kind of tricky, and I see this a lot in partnerships, one partner's going to come in, they're the doer, they got the knowledge, I know how to fix the air conditioners, I know how to do the plumbing, or I know how to make the ice cream. They've got the nuts and bolts of everything, but they're not the money people.
Yeah.
They bring on a partner that's got the money to invest, and they're going to bring the knowledge. This one's going to bring the money. Now, what tends to happen is, not all the time, but sometimes those partners have vastly different tax experiences.
Yeah.
That money person may have their hands in a dozen different business investments and all these things, and their tax brackets, in the 30 percentile, or it could be up there, could even 25%, doesn't matter. It can be different vastly from, now you got this owner operator mindset going into a partnership, married, 2 kids, wife doesn't work, those kinds of things.
Yeah, much different tax life.
So that K1 is going to mean something completely different to partner A than it does to partner B. So sometimes understanding tax planning and how that's going to affect each person is vastly different. And that brings a different level of complexity into the whole mix. And how do you manage and mitigate taxes? Plus, you don't want to mitigate it so much that this person shows no income, and
so many
scenarios that go into that. And that's really the most important thing to understand, is because those K1s actually go to your personal tax return, and that's what's going to drive what your personal tax liability, including that partnership, is going to be. So.
Yeah. Well, and that's one of the most common things, is even people that we've done tax returns for years, or they're just getting going, it's very confusing once you make that switch from a sole proprietor to other entities. I mean, the most common question we get all the time, well, how much does my business owe? The partnership itself is not paying any taxes, like Deirdre said. They are passing through on a K1 to their personal returns.
And there's nothing worse than one partner says, well, how come Johnny only owed $3,000 and I owe $23,000? And you can't compare that because one tax situation is not the same.
Totally different.
So, this 50 grand in income from the partnership can mean something completely different to partner B than it does to partner A.
Yeah.
It could kick a tax bracket up for partner B and, barely make acceptable income after your 4 children
Yeah.
deductions. Yeah. So it is very different. And then you get a lot of that tension on who owes more and
why. Can you explain to me what are the differences, etc.? And then I think that's another question when we get in partnerships all the time is, what is this? What is this line item? Why am I paying self-employment taxes? That doesn't make any sense. We own a business. We're not self-employed.
Yeah, so that is another common misnomer with partnerships, because self-employment tax in a general partnership, so we're going to go back to the most common type, the general partnership we talked about in the first portion, where all the partners have equal or divided up liability and capital.
Cut and dry.
Yeah, pretty cut and dry. In those situations, any income coming out of those partnerships is considered ordinary income on your personal tax return.
Right.
So it is subject to that nasty self-employment tax.
What's the self-employment rate again?
Oh, it's got to be around 15.6 something. I don't know.
Pretty sure that.
A couple decimals in there. It doesn't really matter at this point. It's high. So, that every $10,000, you're talking about $1,500 in self-employment tax. That stuff's going to
just
add
tax
up.
on. It just adds and adds and adds.
Exactly. So that's not even taking into consideration your income tax bracket.
Yep.
So self-employment tax is usually something that does surprise people in a partnership. And again, if you're in a 10% tax bracket versus a 30% tax bracket, the self-employment tax is the same, but the income tax is vastly different.
Brutal.
So it can be brutal. Those are really important things to understand when we start talking about entity structures with multiple members that are pass-through entities, meaning they file their own taxes, but the tax liability falls on the partners.
Right. Yeah. And we talked about this in episode 1, sole proprietorships also have self-employment tax as well. So
yes, they do.
Same kind of swinging method there.
There are some interesting things with deductions, though, when people move from like a sole proprietorship to a partnership.
Oh, yeah, let's touch on this.
Yeah, well, an interesting one I think I hear the most is, I have a home office.
Ah, yes.
Business use of home kind of thing. Each partner might have a home office. Right?
Yeah.
There's nothing to say about that, but by the time that K-1 is issued to you and you go to your personal taxes, guess what? There is no deduction like there is for a sole proprietorship for a home office.
On your personal return.
On your personal return.
Yeah.
And that's usually when people think of it. What about my home office? Because that's when they're used to taking their mileage, their home office deduction, all of those kinds of things are on their personal taxes.
Yeah.
And now we have to have some more forethought in some of those deductions, because they are not after the fact deductions. We need to plan for them inside the business during the tax year. How our home offices,
business 1065 return.
Right. So Is the business going to reimburse you for home office use? Is the business going to reimburse you for your car mileage? Is the business going to reimburse you for your cell phone? Things like that, you want to agree that between the partners, if one cell phone is paid for, is everything paid for? Is it just this partner and not that partner? So there's definitely some more thought that has to go into when you start looking at what types of maybe normally personal expenses might become business expenses. We see that a lot with internet, telephone, mileage, home office. Yeah. Home office supplies. I need a new chair in my home office. Who pays for that? How do I write it off? So those can make a different kind of complexity. It's not that you can't write those things off, but they require a little bit more forethought and
planning. You got to make sure they're all done prior to the whole year being summarized.
Right. It's not an after the fact type of thing, where in a sole proprietorship, it doesn't matter that it didn't go through the business account or whatever. I have out-of-pocket expenses for my cell phone use or the meal that I took my former client out to, and I forgot to bring my business credit card.
Or Kristen, who constantly loses her business debit card 6 times a year. Every other month, I think we're at it.
She really does. So it's kind of fun. But yeah, that stuff it's a bit easier to deal with in a sole proprietorship than it is in a partnership, which is probably going to bring us to some one other thing that I harped on, I think, during sole proprietorships and partnerships, and why it's important. And that is your bookkeeping, your accounting. Extremely important, because we have to understand on the back end to do a 1065, we need a balance sheet. On a sole proprietorship, it's not required.
Nope. Not required.
We need a balance sheet. And that is really also on that balance sheet, it's going to tell us like how much did partner A contribute versus partner B. And we're starting to establish something fun called basis. And this,
Oof. Oh, you're going to unravel into
I'm
basis.
going to unravel basis. We'll get into
That's another episode.
What's a whole episode on basis.
Just give us a little tidbit.
A little tidbit, which is basis is another thing that tends to be an afterthought with a lot of people. And, you know, they're like, I put this money in the business. I'm going to pay myself back. It's not taxable, those kinds of things. But basis is, I tell people, think of it like stock. So you contribute a $10,000 computer to the business.
Yep.
That you already owned, but its value is $10,000. We're going to book that value into the business.
Yep.
So the asset is there for $10,000, but we're also going to increase your basis, your capital contribution for the same $10,000. So you're coming in to this partnership with $10,000 in basis.
Yep.
Now, me, on the other hand, I guess I know all the operational knowledge. I'm going to just bring $5,000 in cash.
Straight cash.
My basis coming in is to put the $5,000 in the bank, and now my capital contribution is $5,000. We might be 50-50 owner, but did you notice what just happened? Your basis is $10,000. My basis is $5,000.
I got a supercomputer on my side.
Right. Why is that important? When that becomes important is getting tax-free money out of the business.
Right.
And lots of different reasons, whether it's just pulling money out in draws, as they're called for
Profit
partner
sharing,
shares,
yeah.
or if it's selling the business or anything like that, your basis becomes, if you think it like stock, I bought Amazon stock for $10 a share, yep, and put $10,000 in, and when I go to sell it, it's worth $30,000. Obviously now I know my basis was 10. I sold it for 30. I have a capital gains of 20, right? Very oversimplified example.
Yep.
Same sale price on me, okay, assuming nothing has changed. I only have a $5,000 basis, so I have a $25,000 capital gain. So
Yep.
you can start to see how basis starts to play a very important role in...
It actually has its branches in a lot of different
things.
places.
And it's not static. It's a moving target every year. Basis goes up.
I tell
With
everyone
profits,
it's a roller coaster.
It goes down when you take money out.
Yep.
Take draws out, it reduces your basis. You put money in, it increases your basis. So
Take losses, decreases your basis.
So it is constantly moving, and it's excruciatingly important to track, because if it, with unknown basis, which again, seen a lot, what happens then when you sell? Guess what? Your basis is going to be assumed to be zero.
Yep.
And that means you have a lot more capital gains or ordinary income to think about. So basis is really important. That balance sheet becomes really important from day one. People think no cash, I contribute a computer, I contribute a laptop, you contribute a refrigerator, I contribute 10 chairs. The reason that's important is because people think nobody paid for anything, that means nothing's worth anything.
No value.
There's no value, and that's not the case. So from day one, basis is really important. So if you haven't been tracking that, you want to find a way to back into some of that, because that kind of stuff, when you go to sell or get out or doing something like that.
We see it a lot too when people are getting valuations and stuff like that. They need full set of financials. If they need to go get loans, we need financials.
Right. So we harp on, definitely by the time you get to a partnership, extremely important to have well-documented, accurate financials. And we're not just talking about income and expenses. We are talking about that pesky little balance sheet nobody really understands.
Yep.
So I do like to make sure that we spend some time on those things, because I think those are the trip points or the trip wires or whatever you want to call them.
I think it's because not a lot of people talk about them, right? They're very intricate, they're very high level, but it's not mean that you can't get a basic understanding of how it functions and serves you currently and in the long run. I think that's what people are like, oh yeah, just tracking how much money I have in my bank account. I'm like, well, that's one part.
Yeah. So yeah, it can get kind of fun. Other than that, I would say your traditional write-offs, deductions, you know, they're not too far off from what a sole proprietorship is. There are some intricacies of special deductions or tax credits that might be more useful in a partnership type of situation than you would never use in a sole proprietorship. And we're not going to get into a lot of the details because tax code's like this big and we only have this much time. So, you know, we want people to understand high level what goes into these things. But unlike that what I read you earlier about the rowboat and the yacht, it's not, that makes people always say, well, I want the yacht, I want the partnership.
What am I missing? Give me some cheat code on how to save taxes.
And it's not a cheat code, because I think it really does keep going back to, depends on that, your individual situation, where the business is, where it's going. You know, are you just going to be one ice cream shop, or are you going to try and become the next Ben and Jerry's? You know, like,
ooh, the Salt and Straw that just opened here in Gilbert, hot commodity. People waited for 4 hours to eat ice cream. Just give it a couple days, guys. Ice cream will be there.
By the way, I think we're having ice cream for lunch, because we've been talking a lot about ice cream.
The Salt and Straw has been on my mind. It has.
Okay. Well, we're going to take another quick break here.
All right, here we are. We're going to do our favorite part of the episode, the myth debunking. You ready?
Myth debunking.
The things that we hear all the time that all over, scattered, TikTok, Instagram. Dang, my shirt's messed up. And that's putting really bad information out to the public, who are very impressionable. So we're going to hit on a couple of the most talked about myths that we see all over.
Hit me.
Partnerships are just like sole proprietorships, right, Dee?
Maybe at some level, but no, they're vastly different in two words: in liability and in complexity. And no, I'm going to add a third, and taxation. So there's some similarities, but there are also some vast differences. And we talked a little bit about some of them along the way. But, you know, when you really start looking at the big differences between, it's not just more people.
Yeah.
More people, think about it, more complexity.
More problems.
More problems.
It's like that song, Mo Money, Mo Problems.
So definitely a little bit more advanced planning in partnerships is important. Definitely when we talked about the operating agreements, but really understanding each individual's liability and how that comes into terms with that.
Yeah.
And how the pass-through taxation works. So they are quite different in that regard. And it's really important to really think about those things up front.
Yep.
More so in a partnership than, obviously, because you're dealing with more people, than in a sole proprietorship where you just have to worry about yourself. So we don't like to think that they're exactly the same, except it's 2 people instead of 1, or 5 people instead of 1. That's not necessarily true.
They would have been the same with the same name.
With the same name, that's right. So
but the IRS thinks otherwise, so they have their differences for sure. Second myth: you don't need a written partnership agreement. I know we went over this in our little first portion here.
So do you need one? I mean, technically, no. I mean, I guess you could say, yeah, in fact, you don't need one. But here's why you would not want to do that.
Yeah.
If you don't want to lose everything you've invested your last 5, 10 years, 20 years of your life in,
your livelihood,
your personal assets, you know, you don't want to spend months in court and all of these things. I think that while it's not required, although in some states it is required to have one, and Arizona is one of them that put that you must have an operating agreement,
or they'll make one
for you that is by default basically just equally split by ownership. So you never want to get into that situation where we were 60-40, we had a handshake, we agreed to it, and then all of a sudden the courts decide you're 50-50 because you don't have an operating agreement. So by debunking that, I like to say, is it required? No, but it's really, really smart. You really need to do it.
We're pressuring you to do it.
Because it does make, on the back end, everybody's life easier, including your own. So
yeah, for sure. All right, myth number 3: partnerships don't have to pay estimated taxes.
Estimated taxes. Well, again, does anybody have to pay estimate? Have to and should are completely different things. No, but they're required by the U.S. government that if you're going to have a tax liability over $1,000, you really need to be making estimated tax payments. The backside of that is if you don't, it's the penalties, it's the interest they're going to back charge you.
And tack right on.
Yes, because everybody I meet thinks I do their taxes, and if they owe 20 grand or something like that, as long as they pay it by April 15th, there's no penalties and no interest.
Yeah. And
we know that that is
so far from the truth.
Right. So we do try and encourage business owners, especially ones showing significant and somewhat significant profits, because we tend to do a lot of tax planning with our business clients. Right. So they kind of know where they stand throughout the year. We try to give them very accurate estimated tax payments to pay, because nobody wants a surprise at the end of the year. Yeah. And then nobody wants to pay 20 grand and then 6 months later get a bill for $1,500 and failure to file estimated taxes or interest back to Q1 and Q2. So it's definitely really important that you really understand where your tax situation is throughout the year, not just wait until your taxes are due.
Right. Agreed. Yeah, no, that's a good one. I think we hear it all the time, especially people that come out of the woodworks that have no financials, right? They'll come to us for consults, which we love meeting new people and talking and leading them in the right direction. But it's really hard to help lead you to pay estimated taxes and be like, well, I don't want a huge tax bill at the end of the year with no financials. Like, well, tell me what I need to pay. I'd probably have a better chance of winning a scratch-off lottery, and I don't win ever on the scratch-off lotteries.
Well, what's interesting too is, tax planning is not, let's have a meeting and tell me what I can do to save money. Tax planning really requires, when you're in business or you have multiple moving parts in your life, your tax life, as I call it, the planning part is understanding how all those pieces fit together, what the outcome is going to be to you in that pass-through situation for your taxes. So it's not, like we were saying earlier with the partner A and partner B, it's not going to be the same for everybody. So planning is an intricate process. And I think it's a very misused term in industry, that I do tax planning. That means I have a meeting with you and I give you a couple of tips. That's not tax planning. Tax planning isn't always about, obviously we want you to save money, but it's not always about saving money. It's about understanding where you stand. It's about understanding, in June that what I might be trending towards owing in taxes this year. And it's about paying in advance. And what's funny is I'll get people to come in, they'll be like, well, what do you charge for tax planning? We'll be like, well, our tax planning services, because they go out, they correspond into, not getting into details of our package, but several meetings and mock-ups and all these things, they start at like $2,500. That's too much money. I'm not going to spend that. But they have no problem writing that $2,000 penalty bill and interest in next June when they didn't pay their estimated taxes. And that's just, it's almost like the penalties and interest pay for the tax planning, and then you hope that the tax planning further reduces your tax liability. Right. But it's really important, and I think estimated taxes it's like a kind of like a dirty word with like, oh, I'm just prepaying my taxes and giving it to the government, but you're not. You're paying things as you
earn them.
Yeah, as you earn them and accrue that liability rather than waiting for it to accrue interest and penalties.
Right.
So I do believe in them. I think they're important, but managing what they are is what's, the tax planning side, which is really much more important.
Right. Agreed. All right. Let's talk about...
She's going to stump me. I can feel it.
This is a good one. You can deduct all your startup costs immediately, your first year as a partnership. Every dollar you spend to start the business, you can write off.
Oh, some of my favorite partnerships are those slow starting ones.
3 years.
3 years, 4 years. They drag on. They got $20,000 this year. $30,000 next year. And startup, they haven't sold a thing or made a thing.
Yep.
And they just want to write these losses off and offset their income, right? And get money back and reinvest in their business that they're building. Doesn't work like that.
No.
And it's one of the most painful conversations to have with somebody starting a business.
We see it all the time, like when we get people's tax returns that they just deducted everything on their tax return, and it hurts me. I get a little twinge in my heart.
Yeah, and it's a tough one because it is a highly auditable thing. And the thing about startup expenses is you can only deduct straight off the bat up to a certain amount. I think it's $5,000 now into your certain types of startup costs, and everything else needs to be capitalized and amortized over 15 years. And that's to ensure that you actually produce a business. You're not just engaging in a hobby for 3 years that you're going to write off losses on, but that you're truly engaged in a process. The number one thing in business is an intent to make a profit. You have to have an intent to make a profit.
To the finish line.
Not an intent to maybe make a profit, intent to make a profit. So in that regard, these certain rules that are in place are to ensure that people don't take advantage of that.
Right. But we see it a lot.
It does happen a lot.
And it's not saying that the people who are in startup mode, it can't take you 2, 3, 4 years to get going. We've seen plenty of business. They need to get people for investments. They're building a product. They have software, or we see a lot of them now creating apps. It does take a long time to build that, but it's just a certain way you have to manage the forefront, because you can't deduct, $100,000 app creation in the first year. You just can't.
So, yeah, that's a fun one and a very painful conversation when it happens, because there are plenty of accountants out there, tax preparers. If you just give them the numbers, they will just take them and not
Yeah, no,
question
yeah.
it, and that's okay. But that gives people a false sense of that's okay,
Proper,
when it's
yeah.
probably just that they're not experienced enough or understand enough
They're
that
not
they
even
can't do that.
explaining. Yeah, maybe they're not even explaining the situation to their tax preparer.
Correct. Yeah.
All right, here's another good one. That one didn't stump you. Stupid. I'll never stump you. Partners are automatically employees of said partnership.
Okay, so in a partnership, typically the owners are not employees.
Right.
That doesn't mean that they can't be, but really in regards to the way the IRS looks at things, they're expecting you to, as a general partner especially, to be working inside the business.
Right.
And since every dollar of profit is already subject to self-employment tax and is taxed just like a W-2 wage, there's no reason to take a W-2. It's actually discouraged.
Yep.
Now, one partner might have, because they put in a lot of capital or something, they're like, well, I'm going to take what's called a guaranteed payment of $5,000 a month, and you're not going to get anything because I'm putting in all the work. Now, that guaranteed payment is deductible to the business like a wage, but it's not a W-2. It's just a guaranteed payment. Will flow through on the K-1 like a W-2.
Correct. And
be subject to self-employment tax for that person, and therefore reducing some of the tax liability for the other person. But a guaranteed payment is not a W-2, doesn't require payroll service or payroll service reporting. So we try to explain that to people, especially don't take on a payroll, liability and expense just for the owners. When you have true employees, that's fine.
One thing, that's one thing.
So guaranteed payments and draws are typically what we see for paying ourselves in ownership. So you don't necessarily, and you probably shouldn't be a W-2 employee of your own business if you're a partnership.
Sweet. All right, we got a couple more.
Yeah, a couple more.
You're my favorite ones. I think we hear the word corporations so much. So here's one about corporations. Partnerships are always easier to manage than corporations. Corporations. Everyone
We're going to get into corporations eventually. I think that's episode 4. But no, negative. I would say partnerships are one of the more complex entity structures to manage and navigate than anything.
Yep.
Now, that might sound funny a little bit because, but corporations, and when we get to that, you'll understand, are so vastly different because they're not pass-through entities.
Right.
They are tax-paying entities. So think of it like you with the owners had a baby that became its own thing, and it takes on its own life. It pays its own taxes. It does all of those things.
Right.
But it also is a lot much more regulated, different policies, procedures, and typically put in place. Partnerships without forethought and all the planning stuff that we talked about can be very complex to navigate.
Yeah.
Very complex, even from a tax perspective, because of the differing ways each partner might end up being taxed.
Right.
And what it means to them. It does cause a lot of conflict. Conflict adds complexity, and hence, I believe, management issues. And I know, I don't like to get into names, but, we've had some, clients in the past where, we have these management structures, manager managed, member managed type of partnership LLCs, and they didn't think about it. And everybody is a manager. Yeah. Even though only one person really is working inside the business or making all those executive decisions. And what ends up happening is you end up in stalemates, and it becomes really complex to get things done because if there's 4 members all like voting,
they're literally head to head about all the decisions. I have a vote. I have a vote. Right. I have a say.
So partnerships can get really complex, and they are not by any means easier. Corporations can be easier, and they can also be harder. But for the most part, when the stuff we're talking about, whether I want to be a partnership or a C Corp, partnerships can get pretty complex situations.
Yeah. And I think it's mostly because of internal conflict, but most of internal conflict comes from how you want to run the business, how someone else wants to run the business. Should we grow? Should we not grow? How come? But what about my taxes? I don't want to pay this much taxes. Let's do this. All those are internal things about how to grow, how to deduct, what should we buy, what should we save. It's all money. It's just the money.
It always comes down to the money.
The money.
Yeah.
All right. Last 2. We're going to hit it with the last 2. You can avoid taxes by keeping money in the partnership.
Yeah, and I think this applies across the board to all sorts of pass-through entities. There's a couple of statements you'll hear me say a lot. One is profit doesn't equal cash in the bank.
Yep.
And, same thing, cash in the bank doesn't mean profit, but usually it's lopsided. People think no money in the bank means no profit, but you could have very high profits and no cash flow. So
Yeah.
that's
Hear that one
definitely
lot.
a falsehood.
I don't have any money.
I never took a dime out of the bank. Everything was reinvested to grow the business.
Yeah.
Therefore, I can have no profit because I spent it all.
Yep.
Couldn't be further from the truth.
Yeah.
So
And it hurts people.
not
Bites them in the
taking,
butt.
I know. And even if it's just as simple as leaving the profits in a savings account or, some type of investment account for future growth,
True.
those profits, if left in the bit, you're still taxed on them. Profits drawn out or not drawn out are definitely taxed
Yep.
in the year that happened. So, I get plenty of partnerships that the people take no money out. They'll have $100,000 and they have to pay taxes on money they never received. And explaining that one can take be a mind-boggling disaster for an afternoon. So, and it's hard for people to understand why. And while I get that, that's just the way the rules and the laws are set out. So, everything comes back to better planning, documentation, knowing where you stand throughout the year, having good bookkeeping, having good accounting.
And it's mostly planning, right? It's the
planning.
people who, yes, they may have really sound financials and stuff like that, but if they're not educated, making, constant check-ins with their accountant or tax preparer, they are normally just taken really by surprise. Be like, well, all that money is sitting there. I didn't personally get any of that money, and the IRS thinks otherwise about your tax bill.
Hence the terminology of pass-through entity. So it passes through the business and to you, regardless. So that's important to understand before you get to the end of your tax year, what that's going to look like so that you don't get hit paying taxes on something you never took out.
Or at least
be aware.
Yeah, at least plan for. All right, last myth. We touched on this about a dozen times now, but I just want you to reiterate. All partnerships are the same.
Oh, well, no. All I would say, the better terminology or better sentence would be all partnerships are different.
Yep.
And obviously we talked about in the beginning, there's 3 different types of partnerships and they really boil down to different types of liability situations and tax situations. So having said that, even if, because we focus a lot on general partnerships today, having even said that, general partnerships I say they're all different because they are. I mean, if this person has, done everything by the book and planned and done all this, those things are going to be a lot easier to navigate than, than another situation, more members, different tax situations. So I feel like partnerships are some of the uniquest of beasts because it's not that they don't have their place. They can be greatly valuable. It's just that you have, again, goes back. There's so many options and understanding in advance
how you want it laid out, how you want it. Yeah,
so
I agree.
I like to say they're all different rather than they're all the same.
Yep. Well, that's the debunk, right? People have this common consensus like, well, they're all the same no matter how you chop it. It's just so far from the truth.
Yeah, absolutely.
Well, those were our debunks for the day. We hope you enjoyed all the things that we love gathering off TikTok, writing down, seeing what everyone's got out in the world. Some of our favorite things. And I'm pretty sure it's because my phone listens to me constantly. It's like the stupid Salt and Straw, right when we got in the middle. Salt and Straw sent me an email telling me about their berry Sundays are going away for the month. But because we talk about this so much, we see so many of these things because my robot listens to me all day and it's constant. We see all these things. We take these from truly real life scenarios that these are the things that people are saying. Just like what we started off about the rowboat and the yacht. Like people are putting that information out there and that's what we're trying to do here in our episodes. Just kind of bring light to some of the things that you could be seeing out in the real world that are just really far from the truth.
Yeah, that hook can get you on Instagram. God knows I've bought enough things off Instagram ads that just are so...
We're suckers.
I'm a sucker for sure. But again, in business, that's what they're doing. You put a hook out there, you reel people in, they buy your product. And right now, we're really just wanting to educate, enlighten, and hopefully, get some feedback and questions from you all that we can help answer or help navigate or direct you in the right spot.
Yeah. Definitely.
So tune in next time for
Episode 3,
S corporations.
S corps. Yep, we're going to dive into the complexities of the
Probably
S corp.
one of my favorites, I think. So
We see them a lot. They're definitely growing, mostly because I think there is some good education that's getting put out there about how people can properly use S corps.
yeah,
And in general, we're just seeing so many things come down from the IRS
yeah.
for S corps. So we're going to touch on some of those things too.
So we will.
See you next week.
So tune in next time.